Test, test, test. No,
Yep,
yeah,
they're on.
that's plenty. This hearing of the Subcommittee on Commodities, Exchanges, Energy, and Credit, titled Review of Credit Conditions Report from Agricultural Leaders, will come to order. Good morning, and thank you for being here today as we continue our review of credit conditions. Our farmers are facing challenging times, from trade wars to weather events, low commodity prices, and general uncertainty. Rural America is indeed being tested. Access to credit is critical for farmers' success, and it is important for us to understand how traditional agricultural lenders, commercial banks, the Farm Credit System, Farmer Bank, and the Farm Service Agency work both independently and collaboratively to address the needs of our farmers and ranchers. Therefore, it is imperative that all lenders work with farmers and rural America during these tough times. Earlier today, Farm Credit announced a new program that will train individuals who work with farmers and ranchers to recognize signs of stress and connect those farmers with professional help. Uncertainties regarding foreign market access and higher ending commodity stocks, among other factors, have contributed to lower prices for many agricultural commodities in recent years, while delinquency rates on residential and all commercial loans have steadily decreased. Since the 2008 financial crisis, agriculture-related commercial loan rates are experiencing an increasing trend. The witnesses before us today know the pulse of rural America and work with farmers on the ground every day. They can speak to the face-to-face interactions they've had with farmers and how that has changed in the last several months with the ongoing low commodity prices and the trade uncertainties. How much longer can farmers continue under these conditions? What happens if there isn't a trade deal with China until after next year's election, as President Trump has alluded to the other day? Our distinguished panel here today works with farmers to offer the absolute best assistance to help continue their businesses. And I'm very much looking forward to this discussion about how we all can best help rural America. And in consultation with the ranking member and pursuant to Rule 11E, I want to make members of the subcommittee aware that other members of the full committee may join us today for this very important hearing. And now I recognize the ranking member, Austin Scott, for his opening statement.
Thank you, Chairman Scott, for calling today's hearing and allowing the subcommittee to continue its review of credit conditions in rural America. Last month, we had the opportunity to hear from the Farm Credit Administration to review the safety and soundness of the farm credit system. We heard that farm debt is forecast to climb to near all-time highs, reminiscent of the 1980s farm financial crisis. We heard about the dire situation for farmers' incomes and cash flow. Despite this, we learned from the farm credit institutions that they remain strong and continue to be a source of credit to farmers and ranchers during these tough economic times. Due to the state of the rural economy, access to credit is even more essential to keep farmers and ranchers producing a safe, affordable, and abundant supply of food and fiber for America and the rest of the world. It's in times like these that our farmers and ranchers are most in need of reliable sources of credit at competitive rates. Thankfully, we have a network of commercial and community banks and the Farm Credit System, each playing a crucial role in providing that access. I might add that after Hurricane Michael, our ag lenders in Georgia worked hard to help keep our farmers afloat. I want to thank the financial regulators for providing flexibility to our lenders during the disaster and those tough times. The Farm Services Agency operates as a lender of first opportunity as well as a direct lender for producers in good standing who may have trouble qualifying for credit elsewhere. FSA is not represented here today. However, I think it is important to highlight the USDA loan programs which provide targeted funding for beginning and socially disadvantaged farmers and ranchers to assist in developing the next generation of producers. FSA's direct and guaranteed loans enable farmers and ranchers to gain or continue financing despite volatile commodity markets. Our farmers and ranchers in the United States borrow more money each year to produce a crop than most Americans will borrow in a lifetime. It is impossible to overstate their need for capital and the investment and return that it brings to rural America. In addition to ensuring access to credit, the 2018 Farm Bill improves the credit title by updating credit authorities to meet the capital needs of modern production agriculture with an emphasis on beginning farmers and ranchers. The need for agricultural credit, given the status of the farm economy, is clear. Net farm income has fallen over $44 billion in inflation-adjusted dollars from its peak in 2013 due to lagging prices and growing world supplies. The crop insurance safety net is in place to help farmers recover from many losses, but it's not designed to address the current issue of multiple years of low prices. Further, while MFP payments that farmers receive are much needed given the unfair trade practices from other countries, farmers would rather be able to sell their crops simply for a fair price. With current economic conditions, I'm encouraged that Speaker Pelosi is going to allow the consideration of the USMCA. I hope this comes next week. It is an important trade agreement that will bring more certainty and open new markets to American farmers and ranchers. I want to take a second to thank Ambassador Lighthouser for working with those of us from the Southeast to address the unfair trade practices that we've seen impact the fruit and vegetable industries in Georgia, Florida, and some other states around the United States. And I'm glad that they will hear from several of the financiers who work with producers every day. They can give us valuable insight of the credit conditions that exist today. And I thank each of you for being here and look forward to hearing your testimony.
The chair would request that other members submit their opening statements for the record so the witnesses may begin their testimony and to ensure that we have ample time for questions. And I would like to welcome our witnesses and thank you for being here. But first, I want to recognize Representative Roger Marshall from Kansas, who will introduce our first witness. Representative Marshall.
Thank you so much, Chairman Scott. Today, I'm very proud and honored to welcome a fellow Kansan, a close friend of mine in the pride of Elkhart, Kansas, Shane Haynes, as a witness today. I remember the very first day I met Shane. It was an icy, cold, wintry Kansas day. I was still delivering babies. I had people in labor, and Shane asked if he could come up and see me. Drove some 3 or 4 hours on icy roads. He should have been in trouble for driving in such bad conditions. And what impressed me, the conversation, was Shane and I talked about the struggles of rural America. And where Shane lives down there in the very southwest corner, several hours away from any major metropolitan area. And of course, we all know the struggles of rural America are the same challenges that any community bank would have. And I look forward to his testimony. Shane has 25 years of experience as a banker in rural Kansas. He brings a deep knowledge and understanding of the unique challenges facing small rural communities and agriculture producers. Since 1993, Mr. Haynes has worked at First National Bank in Elkhart, a town of just 2,000 people located, as I said, in the very tip of southwest Kansas, just north of that Oklahoma Panhandle area. The bank works closely with ag producers and small businesses in the region, facilitating both private, government-guaranteed, and residential real estate loans, as well as crop insurance products. His experience in this role taught him firsthand about the need for strong consumer protections, especially in rural America, where options for financial service providers are limited. In addition to his many years of service at First National Bank in Elkhart, Mr. Haynes has been an active member of the Kansas Bankers Association, serving on various Kansas Banker Association committees related to agriculture, rural development, education. He's a strong voice for rural and underserved areas at the federal level, often joining the American Bankers Association fly-ins to advocate for policies and regulations that impact financial institutions in his community and similar communities across the state. Shane, I want to thank you again for being here today, and I look forward to your heartfelt testimony, and I yield back.
Thank you very much, Representative. Our second witness is Mr. Stephen J. Handke. I hope I got that correct. Good. The Chief Administrative Officer of First Option Bank in Horton, Kansas. And he is testifying today on behalf of the Independent Community Bankers of America. Mr. Handke's family has been farming in Kansas for 4 generations. He holds a bachelor's degree in agriculture economics from Kansas State University and give him a hand, Kansas, and a master's degree in economics from Oklahoma State University. And our final witness is Mr. Mark Nicely. What a name. President and CEO of Ag Country Farm Credit Services in Fargo, North Dakota. And he is testifying on behalf of the Farm Credit System. Mr. Nicely began his farm credit career in the spring of 1981 as a loan officer with the Production Credit Association in Michigan. He is a graduate of Michigan State University, where he obtained a bachelor's degree from the College of Agriculture and Natural Resources. We will now proceed to hearing the testimony. Each of you will have 5 minutes to present your testimony, and when 1 minute is left, the light will turn yellow, signaling time to close is nearing. Mr. Haynes, please begin when you are ready.
Chairman Scott, Ranking Member Scott, and members of the subcommittee, I'd first like to start out by saying your information was very well done and very accurate, so that was very helpful. My name is Shane Haynes, President and CEO. We were First National Bank. We changed charters. We are now Heartland Tri-State Bank. Same bank, different name. We are a $125 million locally owned community bank in Southwest Kansas. We have $51 million in ag loans. However, by comparison, that represents 78% of the bank's loan portfolio. I appreciate the opportunity to present the views of ABA, our customers and ag bankers on ag credit conditions in rural America. Ag credit conditions depend heavily on weather. If you guys could control weather, let it rain when it needs to, dry up when it needs to, that would be helpful. However, since that's not the case, I would say that weather has amplified an already tenuous ag situation. Today, I'd like to outline the current credit situation as it relates to our customers and opportunities in which Congress could offer solutions which would reduce stress on all borrowers and lenders. The ag economy has been slowing since 2012. According to FinBen database, the University of Minnesota, the median gross farm income in 2012 was $189,000. Now, bear in mind, that's before taxes, living, debt service, as such. However, by contrast, that same median farm income in 2018, using the same farm database, was $189,000 in 2012, was $28,600 in 2018. So over a 6-year time span, those farmers' net farm income declined an average of 85%. I dare say many of us could not survive if our paychecks were cut by 85%. This drop continues to cause considerable stress within the industry. While interest rates continue to be near record lows, of great concern is the comparison of total debt to earnings before interest, taxes, and capital, which is as high as it was in the 80s. However, in the 80s, interest rates were at all-time highs. Thus, when rates began to fall, repayment became easier and cash flow stronger. The opposite is the case now. This is important because ag borrowers have a limited number of tools in which to lower debt and cash flow requirements without negatively affecting their overall operation. However, this committee has an opportunity to assist the entire ag industry and provide another tool to ag borrowers. I would encourage Congress to hold hearings and approve H.R. 1872, Enhancing Credit Opportunities in Rural America Act, also known as ACORA. ACORA would lower the cost for borrowers to get an ag real estate loan. This will help them make it through the slow times in agriculture. I would like to personally thank Dr. Marshall and Congressman Van Drew for co-sponsoring this bill. This bill would directly help all ag borrowers. It would allow banks to lower interest rates on ag real estate loans to borrowers and help ease cash flow during these most stressful times. I'd like to remind this committee of the importance of banks in serving the financial needs of America's farmers. In 2018, farm banks, as defined by ABA, as any bank with more than 16% of their loans to farmers or ranchers, those loans increased by 5.3%, and now banks provide over $108 billion in total farm loans, which makes banks the largest ag lender in the industry. Small farmers also rely on banks for funding, as farm banks hold $50 billion in small farm loans. Farm banks are healthy and continue to be forward-looking, growing capital and increasing reserves. This provides flexibility to serve our nation's farmers and manage risks associated with any downturn in the ag sector. I would like to thank Congress, especially the ag committees, for increasing borrower limits on USDA FSA guaranteed loans in the last farm bill. Banks work closely with USDA to make additional credit available by utilizing the guaranteed farm loan programs. Lenders would agree that the increased limits help, but farm operating needs continue to increase. While we are confident these low prices will eventually improve, the reality is lenders must work with borrowers through extended low prices. I would also like to thank Congress for the changes made in ARC and PLC in the last farm bill. Congress should support any programs that help producers become better business managers. Banks like mine are proud of the work we do to support our nation's farmers and ranchers. The ag community is a critical part of our economy, and America's banks remain committed to serve it through good times and bad. Thank you, and I'd be happy to answer any questions you might have.
Thank you very much. And now, I think, Ms. Haneke, you are next.
Chairman Scott and Ranking Member Scott and committee members, thank you for the opportunity to appear before you today. I'm Stephen Hankey, Regional President and Chief Administrative Officer for First Option Bank in Osawatomie, Kansas. We're nearly a 100-year-old institution, and we have 9 locations across the eastern counties of Kansas and northwest Missouri. Community bank credit is critical to the ag economy. Banks provide 42% of all ag credit, more than any other type of lender. And the 1,315 banks, farm banks across Kansas, which is really only a quarter of the FDIC-insured institutions, hold 70% of ag credit of the $184 billion in ag loans. Community banks like mine are 4 times more likely to operate in rural counties than other lenders, and in 600 counties across the United States, nearly 20% are the only lender in those counties. We recently surveyed nearly 2 dozen ag bankers who serve on the Ag and Rural Community Committee for ICBA, and we asked them 4 important questions. The first question is, have you seen deterioration in the portfolios, and if so, to what degree? Number 2, have the market facilitation payments helped, and how long should they continue? And number 3, will you rely more on USDA guaranteed loans? And finally, the 4th question, beyond the ag trade agreements, beyond the farm bill, beyond crop insurance, what can Congress do? The results of the survey and my personal observations will be the basis of my testimony today. First, ag portfolios do remain stable, but are deteriorating. Net farm income should improve 10% this year and should climb up to $92.5 billion. But a quarter of that, $22.4 billion, is coming from government payments. Credit is plentiful, competition is intense, interest rates near historically low levels are all benefiting our farm customers. Banks are restructuring loans with real estate, but bad weather has reduced real estate values locally in some markets, and that makes it difficult to restructure and inject working capital. Banks are starting the loan renewal process this spring, and the outlook will be better known as we work through all these renewals in the spring. Second, on the market facilitation payments, yes, they are helpful. Often it's the difference between losing money versus a slight profit, the difference between making all their payments and not. There should be a predictability in the planning process so that we can incorporate those payments into farmers' cash flows for regulatory purposes next year, and they should continue until prices become stable and rebound. My written statement also highlights a recent article of how community banks have kept one Wisconsin dairy family back on the farm. Number three, the USDA guaranteed loan programs have been critical to the farm economy. One banker on our committee stated, without the USDA guarantees, we would have had to liquidate 25% of our ag real estate portfolio. However, demonstrating positive cash flow is difficult in today's prices. Unfortunately, this has limited access to some of our farmers to the USDA programs, even when they have equity in their real estate. The new loan limit of $1.75 million is helpful. But with the debt, farm debt increasing to $416 billion and the average cost of a farm crop acre at $4,000, we would encourage that limit be increased modestly. Community bankers still say the greatest threat to the farm is the farm credit system. This government-sponsored enterprise enjoys significant tax and funding advantages over community banks. FCS cherry picks our best loans, increasing risk profiles for the bank's remaining loan portfolio. In a 10-state survey conducted by Creighton University, it still lists farm credit services competition as banks' biggest challenge in the next 5 years, greater than negative or slow growth, greater than farm loan delinquencies. FCS continues to introduce products and services that exceed their statutory authority. For example, FCS now offers a so-called Work Smart line of credit, a checking account with remote deposit features that allows customers to, quote, avoid taking checks to the local bank. FCS was not supposed to be offering checking account products or take deposits. Doing so threatens the existence and the charter value of community banks in rural America. Our written testimony also lists some of the other issues that we have with the farm credit services. We strongly urge your vote to the Enhancing Credit Opportunities of Rural America, the ACORA Act, which creates a tax exemption for interest on bank loans secured by ag real estate and home mortgages in rural America. This will lower the cost of interest for farmers. In conclusion, community banks work with their producers both in good times and bad, and let's work creatively to enhance solutions that assist our nation's rural communities. Thank you, and I look forward for your questions.
Thank you very much, Ms. Haynes. We appreciate your comments. Mr. Hanke, please proceed.
Nice.
Oh, I'm sorry. My mistake. Mr. Nicely.
Mr. Chairman, Ranking Member Scott, and other distinguished members of the subcommittee, thank you for calling this hearing today to discuss credit conditions for U.S. agricultural producers and for allowing me to testify on behalf of the Farm Credit System and most importantly, advocate for our members. My name is Mark Nisley. I'm President and CEO of Ag Country Farm Credit Services based in Fargo, North Dakota. Ag Country Farm Credit Services is a financial services cooperative providing financing, crop insurance, related services to more than 18,000 ranchers, farmers, agribusinesses, and rural homeowners across eastern North Dakota, western Minnesota, and central Wisconsin. We currently provide $7.6 billion in loans through our 37 branch office locations and have nearly 600 employees across the 3 states. The impact of trade disputes, disastrous weather, and low commodity prices are being felt by farmers everywhere. Many producers are struggling to even make a small profit, and many others are unprofitable at current commodity price levels. Net farm income, although projected to be up in 2019, remain far too dependent on direct government payments And with the amount of crop that we still have in the field up in the northern plains, that projection is far from a done deal at this point. We greatly appreciate the committee's efforts to pass a strong farm bill, including improvements to the federal crop insurance program. Crop insurance is underpinning the farm economy today. That is especially true this year as farmers had difficult times planting, faced very challenging growing conditions, and have unprecedented harvest issues this fall. Similarly, thank you for your help in enacting disaster assistance earlier this year. Disaster payments are helping many farmers in areas hit by hurricanes, fires, flooding, snow, and other natural disasters. Farm balance sheets that were strong in 2013 are far weaker today. Most worrisome, after 6 difficult years, working capital has declined sharply. Working capital is the cushion against tough times for producers. Many farm producers today, that cushion no longer exists, and increasing debt and decreasing cash flow is not a sustainable model in rural America for farmers. Producers across the board have seen their share of challenges, but perhaps none more than dairy producers. Since the beginning of 2017, Wisconsin has lost nearly 1,700 dairy operations. In Minnesota, 1 in 10 dairies went out of business in 2018 alone. As we speak, Ag Country is working with a 3rd-generation family dairy in Minnesota. We're doing everything within our power to help out, but if markets continue to struggle, 2 families on this farm will lose their livelihood, an older generation will see their retirement nest egg disappear, and 20 part-time employees will have to look for employment elsewhere. This is the reality facing farmers today. Farmers are becoming more financially stressed, and farm credit loan portfolios are beginning to show it. Fortunately, 3 important factors are combining to give farmers and ranchers a chance to survive this downturn: low interest rates, stable land values, and a non-farm economy that continues to provide job opportunities outside the farm gate. Farmers are proving to be highly skilled at cutting costs and taking advantage of narrow marketing windows to keep their operations going. Extending the life of their equipment, managing input costs, cutting family living expenses are all helping farmers continue despite low commodity prices. This expert management by farmers only goes so far, however, and soon many farmers will need to see better price levels to survive. Farm credit is leaning in to support farmers and ranchers. Since the beginning of the downturn in 2014, Farm Credit has increased its real estate and farm production lending by more than $36 billion. We are working with our farm and ranch operations and customers to provide the time and space they need to stabilize their operation and adapt to the reality of an extended downturn in the commodity prices. Our loan officers proactively reach out to customers on their farms to work through options that provide the best possible outcomes. The continuing low commodity price environment is impacting young, beginning, and small farmers as well. Young and beginning operators especially are likely to have much lower equity levels and be more vulnerable to market volatility and the swings and cycles in agriculture. Like the producers we serve, Farm Credit builds financial strength in anticipation of challenging economic cycles by being proactive. We have been fulfilling our mission for more than 100 years and have deep experience in the economic cycles of agriculture. The bottom line is that farmers and ranchers across our 3 states and the country are struggling, regardless of the commodity, experience level, or size of the farm operation. Again, thank you for calling this important hearing. I look forward to your questions.
Thank you very much. Thank you for all of your views. Members will be recognized for questioning in order of seniority for members who were here at the start of the hearing. After that, members will be recognized in order of arrival. And I'll start off. I recognize myself for 5 minutes. Earlier today, several members of Congress joined with me in getting a very impressive and very informative hearing of the effort by Farm Credit to provide mental health assistance to our farmers, our ag producers. And I'd like to start out by giving each of you a little time to talk about this effort by Farm Credit, who are working to support farmers as they suffer multiple elements of stress the weather, the prices, the China and other unknown uncertainties with the trade conditions. If you could just tell the committee about the initiative as you see it, and how Farm Credit is grappling with this, and just what is the American Bankers Association doing to help this mental situation that we're stressed. We see a record number of suicides among our farmers. It's just absolutely heartbreaking. And so I wanted to start to give each of you a little time for us to talk about that, because I really think we need to lay this on the table. This committee is determined to help the farmers with the stress that they are going through. And may I start with you, Mr. Nicely, because Farm Credit is initiating this, and we're determined to make sure this word gets out, what is happening. And I'd like to hear from each of you on how the banking, the community banks can get involved with this. How can I think it was we had the community banks, and there was the other group we had.
American Bankers and the Independent Community.
And the American Bankers Association. Yes, go ahead.
Mr. Chairman, Farm Credit, obviously, lending to agriculture is our primary and sole business. We're a farmer-owned cooperative. We're deeply passionate about what we do in serving agriculture in rural America. We're really going at this from a two-pronged approach. We think it's important for our staff to be well-trained and recognize financial stress and mental health opportunities to help with mental health as they meet with their customers and their clients. And also providing a number of farm credits are under a collaboration where we're actually offering third-party confidential services for our customers to access free of charge, to just deal with the stigma of mental health and making sure that we're reducing any barriers. We often talk with our staff and our customers when we have meetings around the fact that physical health, everybody's kind of focused on physical health, and we actually want to make sure that we have as much focus on mental health because of the stress that's out there in agriculture today. We just think that's an important role that we can play, and we have enough interaction and do enough with our customers that hopefully we can recognize that.
Thank you very much. Mr. Hankey?
Chairman Scott, that's a great question. I'm a farm family, and I went through the 80s, started my career in banking. And so a good deal, at least we haven't got to the stress that we did in the 80s, but I can speak from experience on that. And I think it starts first with relationship banking. And you're a loan officer, you had relationships with your customers. We have deep relationships with those customers and those families as you exited them from agriculture. At the time, we had great resources from the universities, Kansas State University. We also are privileged in Northeast Kansas to have Kansas Mental Health, and that was when we had borrowers that were having stress, we sent them to those services. But more important, I think we were a compassionate lender. And I think it's that relationship. So as you get into large banks and it becomes less relational, I think you'll have more problems with that creditor and the harshness. But I can just speak from the community banking presence. And I'm really proud of is when I go to family events in my community, when we lose one of our elders at a funeral, and that's a person that I helped through agriculture to exit, and we still bank with all of his children, his grandchildren, and his friends. Mm. So I really think the answer is in relationships. And then we do have robust land-grant universities that helped us through that. But I think it starts with the person of the lender.
Yeah, well, thank you very much. We have that. My time has gone.
Could I
Yes.
offer a quick?
Yes, please.
Quick part to that. What you're really talking about is the non-financial factors that go into an operation. We can look at the numbers, and what Steve was talking about is we spend time with each customer, we figure out their break even, we figure out what direction they're going for, as far as an earned net worth process and progress. What ABA started a year ago is an ag lending school. There are a number of ag lending schools around the country that focus on these non-financial factors, the mental side of it, the emotional side of it, and train lenders to recognize that, to see that, and to then be able to send them to someplace that hey, let's get together with somebody. What we do, we don't have a national program like Farm Credit. What we do is we have a farmer focus day once a year. We cooperative with a crop insurance and a farm equipment dealer. We bring in a number, well over 100 farmers. This last year, we actually brought the middle school kids, and so dads got to eat lunch with their middle school kids. And we bring in a speaker, where there's an economist. Last year, we brought in a weather guy. And so you're bringing generations together to learn together. And so that communication, I think, is important. And so I think it's between the education of the lenders and the communication with the borrowers is what will help us work through that in a relationship.
Well, that is really good to hear, and we're gonna get back to that. I'm gonna be very lenient with time with everyone, because we really want to get to some answers to this. We want to solve this. Our farmers are suffering drastically, and this suicide rate is off the charts. So thank you for that. And now let me yield for his opening comments, our ranking member, Scott.
Thank you, Chairman. And when Hurricane Michael hit our state, the first phone calls were from the farmers. The next phone calls were from the banks. And in our part of the world, we have a lot of irrigated cropland. And if you're irrigated, you know you're going to be able to grow the crop. We have not seen the scenarios in the past where we were not able to harvest the crop. We've dealt with price fluctuations and other things, but the last couple of years, the combination of not being able to harvest the crop and the price fluctuations have certainly taken its toll, and our lenders are feeling the pressure. And had there not been some flexibility granted from the feds on some of the lending, I think that there are a lot of our people that would not be able to farm this year, and they were able to farm because of a couple of things. The state legislature and former Governor Deal and now Governor Kemp, through the Georgia Development Authority, loaned some money to some farmers that allowed the banks to reduce the debt that was on their books. And that helped with the interest rates of the farmers. And obviously that has, when you're talking about big numbers, small percentages end up making a difference. But my question gets back to the collateral and how we're going to handle things going forward. Do you expect changes in what banks require from the standpoint of crop insurance to be carried by the producer, or other types of products that provide cash protection, because the banks don't want the land. The banks don't want the land, but what change do you expect with regard to requirements on the loans with crop insurance and other things?
Crop insurance is a huge part of the puzzle, and I appreciate Congress keeping crop insurance whole in the last Farm Bill. That is a huge component, and so I can't underestimate and understate that. What I would say is because there is that number there. We know that number before. We know the base acres, we know the base price. So those producers that have crop insurance, and that's something they have bought prior to the commodity being put in the ground, so they can come to the bank and they can say, here is my guarantee. Here is the bottom line. Regardless of what else happens, I can get that. So our bank, we put that as a part of the collateral. Now, there's still a lending percentage there, but if you don't come to the bank, you may still be able to get a loan, but your collateral is going to be shorter because there's no guarantee there. And so that is something that a farmer can make responsible business decision, take that crop insurance, bring that to the bank, and then that is exactly what it is. It's loanable collateral to our borrowers.
How are you calculating, obviously, I mean, you all testified that farm income is up this past year, but without the MFP payments, farm income would not be up for this past year, and expenses are also up on the farm. So if income's up and expenses are up, I mean, the net can be down, but income's only up because of the MFP. And so my question is, how, we don't know if there's going to be an MFP payment next year or not. Or can you use that calculation and a revenue calculation for the loan?
No, you can't. And those ad hoc programs are very, very challenging. From a standpoint of a cash flow and an operating note, that I can tell you what the number is that we can put in. It's zero. Regulators would get pretty excited. We use FSA. We're proud of our relationship with them. They would kick it out because we don't know. And so it kind of created a two-found problem, especially this year, in that we couldn't put it in there. We can't put it in going in for next year. The payments came and as was testified by the other gentleman, necessary, but it also created a tax hit this year because that is going to be taxable this year, can't be rolled into next year where, sometimes they would roll their grain sales into next year. And so while necessary, one, we can't put anything on next year's cash flow, and we have a tax liability situation.
Mr. Chairman, my time's expired. I have two things I want to mention. One is, as someone who represents 24 counties, and half the counties that I represent, there's only one health insurance company, and in many cases, they don't have a contract with local health care providers. What we're paying in rural America for health care in comparison to what is paid in the metropolitan areas is it's a significant disadvantage to the farm families, and the fact that we're forced to purchase individual products and that product is not in most cases forced to purchase individual products, and the tax law that surrounds that product is not equitable for the farmer, and meaning we have to pay that premium with after-tax income. That's something that I hope we can look at from a cash flow standpoint. I realize it's not in our jurisdiction as a committee, but in the next 30 seconds that I've gone over 1 minute, but you went over 2.5. I want to say this.
Go right ahead.
I do believe that when we write the next farm bill, we need to take a serious look at a step-up provision on the poundage that the farmer is able to insure, because right now you're only able to insure to your 10-year average. Well, when you have a banner crop, there is no reason that we should not allow the farmer to have that poundage appraised and allow that farmer 4 weeks, 6 weeks before the harvest to insure at their option the additional poundage that has actually been grown. And if we could do that, I believe that might get us out of some of these disaster payments. But you know as well as I do, it's unacceptable. My farmers waited over 12 months. Our farmers waited over 12 months to receive any type of disaster payment at all after Hurricane Michael hit the state of Georgia. We just can't. They can't survive that.
Yeah.
They can't survive that. Gentlemen, I appreciate you being here and look forward to continuing the hearing.
Well, thank you for that point, and I would think that committee, while I wish it was ours, we could move with it, but if I'm correct, it would probably be Ways and Means. Is that correct? I would think Ways and Means. and we can talk to Chairman Richard Neal about that. There's so much we want to get over, so many other points I want to make, but I have others that we want to go first, but we'll go for another round if anybody would like that as we go forward, because we really want to get all of our members' positions out on that. And you see, gentlemen, our committee is very determined to deal with this mental health and stressors and suicides. There's no reason for this. And the answer rests with us right here with what we're doing in this room right now. And with that, I'd like to recognize the gentle lady from Arizona, Ms. Kirkpatrick, for 5 minutes.
Thank you, Mr. Chairman.
If you need more time,
Thank you.
please be free.
And thank you, I thank the panel for being here. I grew up on Apache tribal land in Arizona. I'm not Native American, but my father's family came to that part of Arizona in the early 1900s, initially to grow food for the cavalry at Fort Apache. And then my mother's family were ranchers in the area. So I have a long family history with farming and ranching. But my question, because of my tribal connection, is, have any of you worked with Native American farmers or Native-owned lenders? Or just what has been your experience, if any, with Native Americans?
If I could, Congresswoman, Farm Credit does have and has made loans to Native Americans. It oftentimes depends on the reservation, whether they're open or closed reservation. It depends sometimes on whether the property is located on the reservation or on tribal lands or off tribal lands. We make an effort to lend to every eligible farm customer that's out there, farmer out there. And we continue to work in a work group with a number of other farm credits across the country, trying to make sure that we're taking down whatever barriers we can and making sure that we're getting word out as to what can be done to make it easier to lend money to farmers and farm producers on Native Americans. And we've also really tried to get involved with various conferences and that type of thing. And I know last year we were co-sponsor along with Compeer Financial of an indigenous agricultural conference on the White Earth Reservation in Minnesota. And just, again, trying to investigate and do whatever we can to break down those barriers and make sure that we have availability of credit on the tribal lands.
Thank you. Any other comments?
With Northeast Kansas, we have 3 Native American reservations. One of the reservations is the Kickapoo tribe, which is right next to our location. That tribe does their farming collectively. And so in the 35 years I've been an ag banker, and truly we're the town right next to the reservation, I've never seen an ag loan application. Lots of consumer housing and consumer loans, but I think it's probably because the tribe collectively does the farming.
Thank you. No. One of the problems we have in Arizona, we have 22 tribes, and there's very little fee simple land on tribal land. Most of it's held in trust by the federal government. So finding the collateral for the loans has been a real barrier for the Native American farmers. Any thoughts on how we can address that?
Congresswoman, the jurisdiction over the collateral is kind of an important issue. Although I will tell you that and farm credit collateral is not the first thing we look at from a credit factor standpoint, but it does become potentially an issue with tribal land. I think there's ways that financial institutions can work with various trusts and various tribal entities possibly to provide funding at that level and allow them to administer programs within the tribe. So I do think there's ways around this. We just need to get creative and really try and put our minds to it. And I think working together collaboratively with others in the farm credit system and our banking friends, I think we can continue to make progress in that area.
Thank you. Yes.
I have not personally made one. One of my loan officers did work with tribal lands for a while. And one of the things that I think would be helpful, and as if I understood it correctly from him, different tribes have different rules. And that's really what makes it difficult for any lending institution to walk in there when you're not sure what rules. And I don't know how to fix that, but I do know that sometimes becomes a barrier when you're not sure what the rules you're going to be playing by when you get in there.
It's a unique problem. In Arizona, the tribes are considered sovereign nations. So you're doing a government-to-government kind of loan and building that kind of relationship, which is very unique. So, Mr. Chairman, I just want you to know that this is a special area of interest to me. I yield back.
And I thank you for that interest, Ms. Kilpatrick. As so many members of this committee have expressed, we're determined to help our farmers with this mental stress and the many other issues that they're facing. With that, let me now recognize for 5 minutes Mr. Marshall, the distinguished gentleman from Kansas.
Thank you again, Chairman. I'll start with Mr. Haynes. Mr. Haynes, how would the ECORA Act assist your ag borrowers during these very challenging times with prolonged commodity price down cycles?
Thank you for that. The ECORA Act is a very simple act that would lower the borrowing cost for all borrowers, regardless of who they choose to bank with. What it would do is it would make the income earned on interest from ag real estate loans and residential real estate loans in communities less than 2,500, that interest would then be income tax free. While that sounds like a specific carve-out, it just matches what Farm Credit has. And so we're not asking for anything in addition to, we're just asking for the same, because this would allow our borrowers to have the same borrowing costs as other borrowers. And at the end of the day, it would lower credit costs. The simplest example, a 6% real estate loan, which isn't out of line, and that would make sense. We could lower that same interest rate to 4.6. If we could save, as Congressman Scott alluded to earlier, a lot of dollars becomes a little bit, makes a lot of difference. 1.4% lower interest rate helps the cash flows a lot in these low times. And so, and to put some numbers behind it, that's what it would do. It would lower borrowing costs by 21% on ag real estate.
Got it. Okay, let's go to Mr. Nisley next. Are there things that Congress can do to reduce the burdens of customers and encourage more access to credit? What are things Congress can do to reduce the burdens and encourage more access to credit?
I think there are plenty of providers out there for credit, so I don't really see that as a hurdle. I think what Congress can do to eliminate trade barriers and really help with the income levels and the profitability of farm operations is probably the most important thing that Congress can stay focused on. We all deal, the banks and Farm Credit all deal with regulations and things that get a bit cumbersome at times, but I think, for the most part, there's adequate providers of credit, just making sure that we're doing all that we can do to help producers, and that Congress can do all that it can to reduce barriers to trade and other things and open markets for our customers. That's the most help you can provide.
Okay, well, thanks. When we talk about the challenges of rural America, and Mr. Hedke, I'm coming to you next. When we talk about the struggles, the challenges of rural America, very much they seem to be the same challenges of the rural agriculture economy. As agriculture goes, so goes those rural communities. You find me a hospital that's struggling in a rural community, and I'll show you an economy that's struggling as well. And Shane started kind of going in that direction about the community challenges there a little bit. When I sit down with small producers, and big producers for that matter, they describe to me these are the challenges they have. Number one, just the price of wheat or whatever the commodity is. Number two, the cost of health care is a huge cost, especially to a small mom and pop operation. Next, agriculture talks about the lack of people for the jobs that we do have. And then input costs is the next thing. What really matters is giving farmers certainty and giving them a strong economy. Talk about your bank and your role in that community and just expand. Am I missing something, or what would you add to my list that farmers are telling me? Yeah.
My home is in northeast Kansas, but part of our bank is also located in Miami County, which is south of the Johnson County. And what you see in that, it all comes back to jobs, 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 jobs.
It's the economy.
In Miami, in that Miami, we have 5 locations in Miami County, urban, jobs, vibrant economy. In my community, I spent my lifetime in these rural counties, and we haven't been able to produce jobs. And so what happens is you see an erosion of your population. And as the jobs leave, the housing stock goes down. As the housing stock goes, then it eventually becomes difficult to sustain your hospital. And unfortunately, I spent 12 years on our local hospital board, and we just lost that hospital.
That's right.
Now, there was fraud involved with that. It was a difficult situation, but that was a major employer in our small town. So I think it gets back to developing rural America, and if I can't stress anything, I would love to have your vote for the ACORA Act, because that helps. Farm Credit has done a good job in Kansas in rebating back money to their operators. Frontier Farm Credit's the largest ag lender in Kansas. They have a $2 billion portfolio. This year, they expect to send $16 million back to their farm customers. Banks, on the other hand, in Kansas, we have twice the loan portfolio in Kansas, 260 banks, but we have about a $4 billion portfolio in Kansas. If we just had the same benefit, that $15 million of farm credit sent in, we could send another $30 million back to farm rural communities. So I think it would be a good thing. Maybe that's what stimulates that. Maybe that's what helps bring jobs back. So I think I'd highly encourage the CORE Act.
Okay. Thank you. I'm over my time, and I yield back, Chairman. Thank you so much.
All right, thank you. And now I would like to recognize our distinguished colleague from Virginia, Ms. Spanberger, for 5 minutes.
Thank you very much, Mr. Chairman. Thank you for being with us today. In my home state of Virginia, 26% of producers are new and beginning farmers. And we know it's difficult to start a farm and to start farming, especially if you do not come from a farming family, and even more so when the farm economy is where it is today. So given this context, the 2018 Farm Bill made some changes to improve access to credit for new farmers, and one of those changes was creating flexibility so that military experience and other relevant experience could fulfill a portion of or all of the 3-year experience requirement for loan applicants. Mr. Haynes, has that change resulted in an increase in the number of loans to new and beginning farmers from your experience? And how about the other changes in Title V of the 2018 Farm Bill? Have they affected the new and beginning farmers as you've seen it?
I will say the 2018 Farm Bill is still kind of, we're opening it and we're trying to figure out what all is in it and how to best utilize that. The hemp provisions were probably the first one that everybody's excited about, but we're still unraveling some of those. Those are some great additions to the Farm Bill, and we encourage anything with FSA. What I would say with FSA is they need to update some technology, and they really need additional staffing. We can overwhelm them already with the applications we have now, and they do a good job and they work hard. It's not a direction to FSA at all. It's just, they just need more support there. We were submitting with the new Farm Bill and went to 175 and from 300 to 600 on the direct. We were submitting applications before they had the software. I mean, the Farm Bill was approved and it was going, but their software wasn't updated to accept them. And so we were sending applications that they said, we cannot process, don't send these to us. And so not a slam to farm to FSA at all. It comes down to, I think they need more support and they need probably some help from Congress with some money to update their system so that we can implement some of those provisions.
Thank you. Thank you very much, Mr. Haynes, for your answer and also for teeing up my next question.
Could I respond to that?
Yes,
I
sir.
actually have a good report from USDA on that. I was surprised by this report And actually, it's good news because there is great utilization of the USDA loan guarantee programs and direct lending. And so this report is for fiscal year 2019, beginning farmers, and the SDA obligations report. USDA is obligated $5.7 billion, and of that, across the states, $3 billion went to those beginning farmers and the SDA applicants. So 53% of the funding went to those, to the exact applicants. The interesting, and what Shane's saying, it also is interesting, if you go to the budgets for 2017, we didn't use all the money in 18. In 2019, we used less money than 18. So there's a lot of funding appropriation that's not being utilized, and maybe that's because of staffing reductions in our county offices. But it looks like the funding's there. Looks like the programs are being administered well. We just need to get more of those loans through.
Thank you very much. Thank you for adding to that. And Mr. Haynes, you did tee up my next question well, which is focused on industrial hemp. And the emerging market of industrial hemp does provide new opportunities. In 2019, farmers in Virginia planted 2,200 acres of hemp, and we saw increasing interest in both growing and processing this crop. And simultaneously, the Commonwealth and many other states are working to implement the provisions of the 2018 Farm Bill. So, Mr. Nicely, do you believe that your institutions have received clear guidance from USDA and the Farm Credit Administration on lending to hemp producers, processors, or other businesses in the industrial hemp supply chain? And what guidance could be made to help ensure that that's more useful and clearer for you all?
I think the rules are still being written, and there does need to be a little more clarity with that whole area. You know, each state has a little different approach. Some states have had pilot programs out there in the past. We've had some producers that are involved with this early program, but it's far from being kind of certain as to all of the specifics of the program and kind of that whole implementation piece. So I don't know that anybody is holding up our ability to lend money as a system to the industry. But I think everybody's going to be really cautious about going in and financing those operations until we have a little more clarity from the USDA.
Wonderful. Thank you very much. Yes, Mr. Haynes.
We actually had 3 producers try to grow some hemp this year, and it kind of gets back to Congressman Scott's comments earlier. There was no crop insurance available for that. They were doing that out of pocket. And when you're looking at, I think the seed cost can be upwards to $2,000 per acre. You're not going to plant a whole lot of that on your own. And so crop insurance, and I know they're working on it, but we're just not there yet. And so where we farm, you're going to do wholesale, you're going to do 160 acres at a time. You're going to have crop insurance on that. So we need to get those rules out.
Thank you. Thank you very much.
If I could add, I think the reason there's so much interest in it is farmers are very innovative and they're just looking for new avenues to generate revenue, particularly in this farm economy. So anything we can do to open up new markets, whether it's hemp or anything else, I think that is, a very important step forward for agriculture. And I think anytime you offer those types of opportunities, you're going to see interest in rural America to address that and try and leverage that in their operations.
Thank you very much to the witnesses for a good conversation about new industries and new farmers. I yield back and thank you for letting me go over, Mr. Chairman.
No problem at all. Thank you. And now we will call on Mr. Johnson from South Dakota. 5 minutes.
Thank you, Mr. Chairman. Mr. Haynes, in your testimony, you noted the importance of us helping producers become better business managers. And of course, you mentioned that can come through, lenders and ag groups and extension offices, of course. You particularly called out the importance of hedging as a good business approach, good business strategy. So I want to think about a little bit, and I'll ask about both farmers and ranchers, because I think the answers may be different. Talk to me about, with your farmers, row crop guys and others, what are the trends? What's the evolution of these hedging practices, from a risk management and a buying down volatility perspective? Where's the next frontier, if you will?
Something that actually my mentor, I guess. He pushed marketing 20 years ago. And so our bank in particular, if you were our customer, you came, and we still do the face-to-face renewal. You come and sit down, and we do your cash flow together. But when that borrower leaves our office, they know their break even per bushel, per pound, and when they leave, they know exactly, I got to sell this calf for 68 cents or 88 cents or whatever. I've got to get 3.48 for this bushel of wheat.
And they have a plan about how to kind of move different product through at different
Right.
price points.
And so then, like for cattle, for example, in South Dakota, so when they go to the auction and they're looking to buy stocker cattle or fat cattle, whatever, they can have 2 or 3 break-evens there in front of them. If I buy a 6-weight, I can pay up to this. If I buy a 4-weight, I can pay up to this. But part of that break-even, we factor in a hedge, a put against it. And so we're setting a floor, we're not limiting the top side. So part of the break-even is the marketing, is the hedging portion. And we're pretty proud of the way we do that we give that information at least for our borrowers.
I get the sense that the level of sophistication is higher on the farming side than it is in the ranch side. I think there's some data to suggest that. What has your experience been?
There may be. I would say they're catching up.
Mm-hmm.
We've moved into a time where everything costs more and the margins are smaller. And so everybody is having to get more efficient, more knowledgeable. After 25 years, what I've been able to see, and I think probably all panelists, going from one generation to the next, that first generation may not have to market, and they may do it however they want, and they may hold their grain for 5 years. But as you move to newer generations, they want to learn, they want to understand, but they also have higher debt levels, so they don't have the room, they can't make the mistakes. And so as I see this generational transition, it's fascinating to watch these younger guys coming in because they want to understand it. They don't want to take the risk because they've got enough debt level out there already.
So, I've introduced the Livestock Risk Management Education Act, and there are others, including, Ms. Spanberger, who are showing some interest and wanting to show some leadership. So as we try to build the right bill and create the right mechanism, are there things we should keep in mind with regard to building a higher level of success within the livestock arena for hedging?
It's just going to come to education.
Yeah.
Where the education part has to get, and I don't know how to do this from your side, is we need to get it down to the farm level. And that, I think, we can come up with programs by getting it all the way down to the guy. So whether it's extension, whether it's, land grant universities, whether it comes through the financial side, somehow to push that all the way through. FSA would be a great avenue to do that as well. But get that education down to the producer. We hold farmer meetings, and that's what we talk about. We'll bring in a speaker and let them explain that to them, and I think that'd be a great avenue.
So, Mr. Handke, Mr. Nicely, are there other things that either of you would want to mention with regard to hedging?
Well, I think you have 3 approaches. You develop the program or the legislation, you have the education, but then you have to have the utilization. So getting the utilization of the farm customer, I mean, that's the last step of it, so utilization.
I think it's been hit on, but really helping producers understand what their break-even costs are and really positioning that operation so they know when good marketing opportunities are available out there. And I think in regards to livestock in particular, if you look at the value that crop insurance, federal crop insurance has provided for for row crop operations and small grain operations, if you were able to target a program for livestock similar to that to provide that kind of revenue coverage, which has been worked on, I think that would pay big dividends long term as well. It really allows people to market not knowing what their production is going to be.
Yeah, well said. Thank you, Mr. Chairman. I yield back.
Thank you, Mr. Chairman, and appreciate all of you being here, and giving us your expert testimony. In Indiana, one of the things that we've seen is that the land values have declined, say about 10.5%, 10%. They seem to be holding steady right now. but at some point, the demand on the net investor side is probably going to be able to make up for the lack, or not going to let us make up for the lack of interest and ability of the farmers to purchase that land, which is an extremely important part of the process for them. So what are you able to do to mitigate the effects of potential decreases in land prices and the effect that would have on the credit for the farmers? Because I remember very well the 80s and going through in that, and I can tell you that you cannot pay 20% interest on operating loans and come out ahead. So I think that we have, from that experience in the 80s, and I hope that's transferring over to our younger generation, I think we got interested in keeping our debt-to-asset ratio less than, say, 0.36 or less than 36%. And to my knowledge, that has been true. So anyway, I'm asking how the impact of the land values and our debt load on these young farmers, because they're more likely to be highly leveraged, and they're going to have to take over the market or take over the industry for the future. So
All of us on this panel know Dr. Cole, right? I just heard him speak just the other day, and he compared land values to Swiss cheese, meaning some of the land values is the same number as it was before, and then you've got cheese, and then all of a sudden you've got a hole where it's declined substantially. And I think there's some truth to that. Farmers are now making not only a quantity decision, there's a piece of ground for sale and I want to buy it, but they're making a quality decision. And they're looking, what is the irrigation? What's the water in that? What's the quality of the dirt? And so farmers are now being very selective, and they're paying the same price for good ground, but ground that shouldn't have been broke out or isn't as good of ground or isn't as good of water, those prices have dropped. And so I think what you will hear is you will hear stories of the same land price and considerably lower land prices, and I think it probably would wind up being a quality of land decision, which is the reason we really appreciate your interest and your support of ECORA, because that is exactly what ECORA would do. It would allow us to lower interest rates on farm real estate in times when we need it. And I just can't stress that enough of what it would allow us to be able to do for our producers.
But I think also that a lot more fixed rate lending now. I mean, Farmer Mac allows us to lock those rates in. But that is a good axiom. That's an axiom in our area, is nothing goes up faster than poor ground, and nothing falls faster than the poorest ground. So we're probably at that cycle where you're starting to see some of those poor farms plummet. But luckily in Northeast Kansas, our farm real estate values have maintained. And that is the one key that's different than the 80s. We couldn't refinance and sell. But as long as the real estate's staying strong, it gives us a source of collateral to restructure.
Congressman, I think the most important thing we can do to support real estate values is to be prudent in our lending practices and not let real estate values get out of hand. And I think the financial institutions across this country have done that. We all look at long-term averages of commodity prices, and we lend into the cash flow of those farms. We don't lend on collateral value. So I think prudent lending is probably the most important first step. And in regards to young and beginning producers, really being able to leverage the FSA programs, the guarantees, and the young farmer direct loans are really a big deal. And I know even within some of the state programs that we deal with the Bank of North Dakota and the Rural Finance Authority, the RFA in Minnesota, to do partial financing, we're able to get buy down on interest rates for some of those young producers as well. And so we're able to get young operators on those farms and make better use of that, I think, from a generational transfer perspective.
And I'd like to give a little shout out to Farmer Mac, because that is another tool we can use on farm real estate that allows us to push some of that interest rate risk off of the bank's balance sheet and allows us to offer terms that we couldn't offer on our own. And so Farmer Mac is another tool that you guys have put in place for lenders, but really for ag producers. And so I'd like to say thank you to you guys and thank you to them.
Thank you very much, and I see I'm out of time, so I yield back.
Thank you very much, and thank you for your line of questioning on the beginning farmers. We got so many issues, so many critical issues facing our farmers and our agriculture industry. And, but we're going to have a little second round here in case anybody wants to come back. But we'd like to hear from Ms. Acne. She just got in, and she's one of our outstanding representatives, stands up and loves farmers, Ms. Acne from Iowa.
Thank you, Chairman and Ranking Member, and thank you to the great witnesses for being here today. Really appreciate it. It's important that we're holding this second subcommittee hearing to review credit conditions for our farmers, so I'm glad to be here so you can share your expertise. My job here is to listen directly to you all because we've got a lot, as the Chairman just explained, happening to our farmers, so I'll cut right to it. As many of us are sharing today, I share the concerns of my constituents who are worried about the state of the farm economy. I mentioned during our last hearing with the FCA Chairman Smith that my home state of Iowa has the highest level of farm debt in the country at nearly $19 billion. And that a recent study classified 44% of Iowa farmers as financially vulnerable. So that's very deeply concerning to me in our state. As you all represent the majority of ag lending, can you quickly describe the tools you have to help identify distressed borrowers and how, if at all, you work with them to find a solution?
Well, I'll start, and I think it's been mentioned earlier, Congresswoman. You know, it's really about relationships and understanding and have a deep understanding of your customers and what their financial operation is, what their goals and objectives are. And making sure that we're leveraging all the tools that we have to educate and share that information with our customers. You know, for the most part, and I know that we've had producers that have struggled primarily because of yields. We've had pockets of the country that have had really good yields over the last couple of years, and we've had pockets that have not had such good yields, and that seems to be the determining factor where that stress is showing up. I have to do a shout out for our customers in the Northern Plains. You know, we had a really rough spring trying to get crops in, way too much moisture, a very poor growing season this summer, and a harvest that won't end. We can't seem to even get the corn out of the fields. We left over 100,000 acres of sugar beets and potatoes in the ground this fall up in the Red River Valley, which are not harvestable at this stage. So when you add those kinds of factors in, even with crop insurance as a safety net, you're still not getting the level of profitability that you need to maintain that working capital for your customers. So we look at working capital quite heavily. We've been promoting working capital with our customers and clients for an awfully long time. Even when it doesn't appear that they need working capital, making sure that they're building working capital and maintaining that cash position so when they run into a difficult time, they have that safety net there is really important. And again, just making sure that we're lending money to operations based on the long-term averages of commodity prices and those types of things, not overreacting to price swings in the market and possibly over-lending. I think we're all, everyone at this table is very cognizant of making sure that we're not, sometimes saying no to customers is the most important thing you can do for them to try and keep those debt levels in check.
Okay. I wanted to ask a couple more questions, so thank you for that answer. I got relationships, working capital, not overreacting, and certainly not overlending, so thank you. Were there any other additional pieces to that?
Well, when you were saying that, I was reminded of the wise words of my wife, communication. You know, get in, talk to your banker, talk to your customer, it is that relationship, but it's that early signs of this isn't going the right direction. And so I won't take up your time, but I think early communication and constant communication between the borrower and the lender is the way we get through these situations.
Okay.
I'd have a little different approach. In my testimony, I talked about the ICBA Ag Committee that I chair, and one of those great leaders on that's Larry Whittam, and he says hello. So he represents you well on that committee. But one of the things is we came through this golden age from about 2006, and our farm customers, all of them, booked a lot of capital. And so I think all of our farmers are well capitalized, tight cash flow, well capitalized, lots of equity. But in order to have the time to use those tools, we have to make sure that our regulators don't expect us to solve a farm problem in 18 months. And for the banking industry, we want an 18-month cycle. So yes, we have those relationships identified and we're working with them, but we have to make sure that we keep our regulators realizing that this may take a 3-year process. It may take a 5. Farmers will get their way out of it. It may take a while for the markets to rebound, but agriculture is not solved in one operating cycle. So I think we have the tools, we have the equity, just need time to work with them through it.
Well, very good. Last question. When FCA Chairman Smith was here before, he noted a rise in farmers going outside of traditional banks. I call them payday lenders. Have any of you also seen a rise in this, and do you share those same concerns?
Yes, we do. We've seen that rise, and it's concerning, not because of the competition. What's concerning is a lot of times those are kind of point of purchase. It might be a tractor, it might be some specific piece of equipment, piece of their operation. Well, as we do our renewal, we look at the entire operation. We look at capital debt repayment ratios and a lot of information. That payday lender, I love the way you said that, is looking at one thing. And they're saying, here's the piece of equipment or here's the whatever I'm selling. And so they're looking at their item and not the relationship and not the entire operation. And so the stress and the concern to me as a lender isn't the competition. It's how that one extra, the straw that broke the camel's back, then they come into us and they can't figure out why they didn't break even. And so that's the struggle that I have with that.
Congresswoman, we have not seen a lot of that in the Northern Plains, so I'm not familiar with that. Again, I think in working with customers, having a good relationship with them, understanding that whole business operation is kind of critically important, and we haven't seen an abundance of that up in the Northern Plains.
I'm glad you're not.
I think I'd agree with Shane, is that it's not the subprime lender, it's John Deere Credit pushing out equipment that they just can't cash flow. So that's probably more, I think, is the intermediate lenders, not the payday in our market anyway.
I appreciate that. So it ends up impacting, though, the operating loan and that they're working with their bank on. So, okay, thank you for that. I very much appreciate it.
Thank you, Ms. Saxony. Now, the chairman and I, and Ms. Saxony, if you are still here, I'm opening it up for a second round because I want to really get to some real things that we can do. First of all, I want you to know that I've asked the staff on this committee, because you got to realize that our committee, this subcommittee, is the financial arm of the Agriculture Committee. There are things we can do. There's legislation that we can do as well. I am so proud of what Farm Credit is doing, and they are sort of like opening the door to something we've only been dimly aware, and that is the financial plight in and of itself and challenges that are facing our farmers and our rural communities. My ranking member, Austin, was just talking about this need, and we're going to go with that, and I want you to talk about that just a little more. And we can put that to Richie O'Neill, our chairman of Ways and Means, to get that legislation moving. I've asked our staff to look at two very important areas that we are glossing over. I mean, there is something going on that's causing so much anguish with our farmers that I think are contributing massively to this mental stress and suicides that we can do something about. The first one is the weather patterns. There's something going on where we have had back-to-back storms, fires, half of the West Coast, fires, lava spewing in Hawaii. back-to-back hurricanes and floods. They've caused massive damage. But here is the greatest damage. That greatest damage is that we in Washington failed immensely in getting the aid to them. And I am convinced that that played a role in the high suicide rate of our farmers. So, one of the two things that I've asked our subcommittee to do is that we got experts, we have scientists, we have space programs where we have great knowledge of the universe, its past, its present. And yet, with the havoc that our weather patterns are causing our farmers, we have yet to get our scientists, our knowledge into this agricultural hearing and let them educate us and the farmers of what they know. And I'm hopeful that our staff, we got some great scientists out there. You got some great people on there. It's no politics in this, to whether there is climate change or whether it's not. I know one thing. We need to know what is happening out there so we can help our farmers prepare for the hurricane before the storm is raging. And I hope we can get that hearing. That will help everything. And the second thing is, we've got to do something more to set up what I think is an emergency contingency fund that is set up here in the federal government so that when the storms happen, and then you got to say, well, we'll get emergency aid down, and you're going to put it through the CR process, the appropriations, and it takes 2 or 3 years to even get the help down. Now, we need to do that, gentlemen. Now, if we do that, then we're serious. You can't do that. You don't have Farm Credit, bless their heart, they don't have as much money as we do. It is our response. Now, I've watched this television program, and I ask you to watch it maybe over the holidays. Our own Smithsonian Institute puts it together. It traces America's development. And it's called America in Color. With the 20s, the 30s, the 40s, the 50s. You talk about challenges that our nation had. And at the center of those challenges was agriculture. Whether it was the Dust Bowls, the boll weevils, everything, the Depression. We had magnificent leadership here in the federal government, in Congress, in the White House, to respond. We're not doing that now. And so we want to really get to the bottom of it on that. And then the other fact that I'm so glad that many of you already mentioned was the beginning farmers. Our farmers, not only are they suffering, not only are they committing suicide, but the average age of the farmer is 60 years now. We're not nearly doing enough to get this new generation, younger generation, into agriculture. But we responded in a small way to show you what we did do. And in a bipartisan, Democratic, Republican way, We got scholarships to the 1890 land grant, African American colleges and universities. That's out the box. So I just wanted to lay that out. My staff is going to go to work and get these two hearings in here so we got so much advanced knowledge out there, even with our space program, to be able to help us. What's coming down the road so we can prepare for it? So I just wanted you to know that. And I have a couple other things, but I want to share my time here with Mr. Scott, who wants a second round as well.
So just to reiterate one of the things that my friend and colleague mentioned, it took so long for Georgia to get disaster relief. The question is, should we have an account sitting at USDA with rules and parameters around how disaster relief would be appropriated in the event of in our case, it was a hurricane. In the Midwest, it was floods. It could be droughts. It could be excessive moisture. But if there was, should we establish an account at the USDA specifically for ag-related disasters that would keep what happened to us from happening in the future? And that's easier said than done. Anytime there's a pot of money sitting somewhere in Washington, D.C., someone does their best to dip their hands in and get it out, and oftentimes it doesn't go to the intended parties. But that is something that I think we will continue to discuss as the Ag Committee. The farmers simply can't wait a year to get the disaster relief. If it had not been for our governor in the state of Georgia, our farmers wouldn't have been farming. We would have missed this crop year had they not done what they did through the Georgia Development Authority. One question I have, we have talked a lot about the 1,000-acre limitation with Farmer Mac, and you mentioned slight increases in the $1.75 million authority. I know y'all use Farmer Mac in different ways. Can you explain the relationship with Farmer Mac and what suggestions, for those of you in the private banking, the relationship with Farmer Mac, how that works in allowing the lower interest rates, and the 1,000-acre limit and the loan limit, the challenges with that?
I can, and Chairman Scott, when you were talking, I would like to, Farmer Mac actually provides, they actually give us economic data. They help us with some of those trends and some of those things that are out there. And so Farmer Mac provides a number of services. But Representative Scott, that the 1,000-acre rule, while well-intended, has just outlived its usefulness and now has become almost a barrier. And so what has happened, and I have not done this, I want to make sure the regulators know, if they're listening, I have not done this, but what financial institutions have had to do is they've ended up taking that one loan that would have violated the 1,000-acre rule and the limit, then they've broken that loan into 4 or 5 new loans, individual loans, to stay under the 1,000-acre rule. And so all of a sudden then we have 5 loans on the books that we have to track. We have 5 payments. It nests the same, but it doesn't make sense. It's a simple fix. We looked at it, the Farm Bill. As a financial institution, we lend as a percent of capital. Farmer Mac has a capital. Just change it so that they can lend as a percentage of capital. I think they were even offering 10%. Whereas we can loan up to 15 or 25% of capital, depending on our charter. They were just asking for 10. And so that eliminates, when Farmer Mac started, the 1,000-acre rule was there, they didn't have much capital. But now flash forward a number of years, they've developed a substantial capital amount. Just making that small change would get would make a long-term and a fix for the 1,000-acre rule and would be much more beneficial to both financial institutions and Farmer Mac, frankly.
Okay. Mr. Chairman, I appreciate the committee being here and the experts that have testified before, so I yield the remainder of my time. I don't have any further questions.
Ms. Agnew, would you have any closing remarks you'd like to ask?
Thank you. I did have one question that I wanted to get to as well, that I'm concerned about outside of bankruptcy rates. Have any of you seen an increase in farmers having to sell off their assets to pay down their debt at this point?
We have not gotten there in our area. What we have seen for the first time ever is generally there was those producers in the area that didn't matter where the land was, they would buy it. We're, for the first time in my 25 years, those individuals, and so you had a floor. You knew that so-and-so would always buy the land if it went cheap enough. We're now seeing those individuals starting to sell acres. And so, as the chairman referred to, we are about to see a large number of acres change hands. And it's a great opportunity for the young beginning farmers to have a shot at ground because we've got some large landowners selling. Now, it's not forced. It's more of a retirement and getting their estate in order. But the next few years are going to be an opportunity, I think, as we transition to the next generation of farmers.
I think I'd comment that probably the borrower class that we have the most difficulty with are the farmers that were within 10 years of a life event and still farming. So you can imagine the 70-year-old farmer that's going to continue to have his cows. He has high net worth, doesn't really care what he's operating. It's what I call the farm reverse mortgage. And those farmers are going to do that until they either their health leaves them or they have an estate sale. But unfortunately, you know what? The regulators call those substandard loans. So if they don't cash flow over a 2 or 3 year period, it makes it difficult for us, even if they have a 20% debt to asset ratio, there will be a liquidity event. So what you're seeing is maybe some of those customers selling off some of their assets. But in our market, I haven't really seen the production farms. And in our neighborhood, production farms are in that 1,000 to 5,000 acres. Our family's always farmed about 2,000 acres. 20 years ago, that's a big farm. Right now, that's a small farm.
Congresswoman, I think that, farmers operate and ranchers operate these as businesses, and we're not seeing forced sales. We're seeing voluntary sales in some cases where maybe they want to restructure a balance sheet, maybe they want to transition something to the next generation. So we're not seeing an abundance of that, but it's surely a tool that farmers will use to help, better prepare their balance sheet or improve working capital. I think farmers today look at assets just like any business would, and maybe aren't as attached to them as previous generations were. Farmers are willing to make changes to their operation as they see fit to make sure that they have good, sustainable structure going forward.
Thank you. And just closing, I'd like to reiterate what both Mr. Scotts, our chairman, and our ranking member said about ensuring that the USDA would be able to get funding out as quickly as possible after a disaster. Mine is the flooded district in Iowa with the Missouri River. We are still waiting on funding. I would say that of many of the departments, the federal organizations we're working with, USDA is doing a pretty darn good job compared to some of the others at this point. But there's plenty of room for improvement. One of the things I'm glad we're talking about this is an opportunity to try and work with them that I'd like to see if it put some standard operating procedures in place for disaster. I noticed that that's not across the board anywhere in government, no matter what disaster it is. Obviously, the different disasters will have variables. Flood's different than a fire. But you know what? We really kind of go through the same standard set of things that we need to be doing to get the funding out to the folks folks in need. So I'm glad you brought that up. I'd like to see us continue to work on that with you folks to see what might be the best opportunity. But, right now, we don't know. I mean, we've still got silt on our land in many cases, several feet deep. We know that the high probability of the majority of our farmers in that area won't be planting next year, but I would like to get them, into the fields as quickly as possible, if not next year, the following. And, hearing stories about how so many people have had to wait years to be able to start regrouping and getting some market share is unacceptable. So anything that we can do to move that agenda forward, people literally are falling by the wayside as a result of government practices that aren't moving in a timely fashion. So if you do have any last-minute response on that, that'd be great.
I just want to complicate an already complicating challenge. For the congressman from South Dakota, like the MFP, it was valuable and necessary, but there were no provisions for the livestock producers in the MFP program. And so while you think of all the potential disasters and then put a fund there to keep people from getting their hand in the cookie jar, don't forget about the livestock people as well. That's a great challenge. Maybe you guys could knock that out by Friday, but that'd be great.
Which Friday?
Congresswoman, if I could add, I think speed in getting disaster assistance out is just critical. Farmers operate on a production cycle, and they don't have years quite often to put that disaster money to use. So I think speed in getting disaster money out. And I also think if you're able to build in some flexibility with things even like crop insurance, where you need to make decisions in the spring, and that information about prevented plant, and maybe there's a situation that developed that wasn't anticipated, having the flexibility for USDA and the Risk Management Agency to make adjustments to things like crop insurance could help soften that disaster blow, I think, as well. So not only speed at getting the disaster money out there, but also flexibility with some of these other programs that could address this maybe in advance and be more proactive.
There is one that kind of going along with that we did look at the Farm Bill. It ultimately did not get put in the Farm Bill, but might help with these disasters. We moved ARC and PLC from NAS to RMA data, and that was helpful. But what would have even been more helpful, that price is still a post-harvest price and is some 12 to 18 months after the operating year. If we could just move that price to be the same as the crop insurance price. And so then farmers would know prior to planting, they would know their crop insurance price, and they would know where their ARC PLC price would be. And they could make more informed, educated planting decisions prior to getting that money out there. And then even if the money for budget purposes couldn't come until later, then as a lender, we could also put that in the cash flow. Here's a number. We could use that for FSA guaranteed loan applications. We could use that with regulators. And so it doesn't really change anything as far as the timing, but what it does, it takes some uncertainty out of it for both the banks and the producers.
Well, and it allows producers to do a better job of marketing because they know that in advance. It isn't retro all the time, so.
Yeah.
Good information. Thank you very much.
Thank you, and thank the entire committee. And as you can see, we're both Democrats and Republicans here are very committed to this. And I close with a reminder of the good word from the Lord when he said, get wisdom, get knowledge, but with that wisdom, with that knowledge, get understanding. We don't have understanding until we can get the scientists in here. We get our space people. We get people with knowledge about these changing weather patterns. So we know what's happening. Something is going on, and our farmers are suffering. And again, I ask my staff to put that together. Then secondly, we need to get back together on a contingency fund. We got to hear from people. Well, my idea of a contingency fund, having something there, because I tell you the truth, As long as we try to say we're going to get emergency relief down to people, when the floods are flooding, the fires are firing, the lava is doing everything it's doing to our country, and it goes through the appropriations process, you all follow us up here, and that's not the way to do it. So all I'm saying is, if anything comes out of this meeting today, there are two great things coming out of this meeting. What the bankers are doing, the independent community bankers, the American Banking Association, and of course, our great pioneers in moving forward with your mental program, Farm Credit. You all are our soldiers out there on the front lines. We sit here in Congress with massive resources, and we need to get the Franklin Delano Roosevelt instinct and the Dwight David Eisenhower instinct. Dwight David Eisenhower said, hey, we're tired of running on these muddy roads. Let's build the interstate highway system. Look what it did. And what Franklin Delano Roosevelt did. Responding, lifting up farmers, and proved that farmers were the backbone and the soul of this nation. And we got to stop letting them down. Thank you all very much. I've got to read this properly. Under the rules of the committee, the record of today's hearing will remain open for 10 calendar days to receive additional material and supplementary written responses from the witness to any question posed by a member. This hearing of the Subcommittee on Commodities, Exchanges, Energy, and Credit is adjourned. And thank you all very much.
I'm going to tell Sanford.